Welcome to this comprehensive lecture series on the Indian economy. Today, we are diving into a fundamental macroeconomic concept, national income. We will explore what it is, its history in India, and the various ways economists measure it to gauge the health of a nation. At its core, national income is the aggregate of all factor incomes. This includes wages, salaries, rent, interest, and profit earned by the normal residents of a country during a specific accounting year, which in India is from April 1st to March 31st. In simpler terms, it is the total value of all final goods and services produced by a country's residents, whether they are operating inside the domestic borders or abroad. We measure this massive aggregate using various metrics, like GDP and GNP, and we can value it either at the actual cost of production, known as factor cost, or at the price consumers pay, known as market price. To gauge how well an economy is doing, we rely on specific economic performance indicators. The GDP growth rate is the primary metric used to indicate the overall performance and expansion of the country over time. However, to understand the actual standard of living or the level of economic development compared to other nations, we look at GDP per capita, which divides the total economic output by the population. Let us look back at how national income was historically estimated in India during the British period. The very first attempt was made by Dadabhai Naoroji in 1868, who calculated an annual per capita income of just 20 rupees. Later, in 1931 to 1932, Dr. V.K.R.V. Rao introduced the first scientific method for this computation. He innovatively divided the Indian economy into a primary sector, like agriculture, and a secondary sector, like industry, arriving at a per capita income of 62 rupees. After independence, the Indian government needed a formalized system. The first official attempt to compute national income was led by P.C. Mahalanobis, who headed the newly appointed National Income Committee. Their first report, presented in 1951, estimated that for the year 1948 to 1949, India's national income was 8,710 crore rupees, with a per capita income of 225 rupees. Over the decades, the institutional framework evolved. For a long time, the Central Statistics Office handled these estimates. However, in 2019, the government merged the CSO and the National Sample Survey Office to establish the National Statistical Office, or NSO. The NSO operates under the Ministry of Statistics and Program Implementation. Additionally, we have the National Statistical Commission, an autonomous body formed in 2005 based on the Rangarajan Commission's recommendations, which oversees statistical standards. For the modern computation of national income, the NSO divides the Indian economy into three broad sectors. The primary sector includes agriculture, forestry, fishing, and animal husbandry. The secondary sector, or industrial sector, covers mining, manufacturing, construction, and utilities. Finally, the tertiary, or service sector, encompasses trade, transport, financial services, real estate, and public administration. It is fascinating to observe how the structure of India's economy has transformed over the decades. In 1950, the primary sector dominated, contributing 55% to the GDP. Fast forward to the 2023 to 2024 data, and the landscape has completely flipped. The tertiary, or service sector, now drives the economy at 54.7%, while the primary sector's contribution has shrunk to 17.7%. Reflecting India's shift towards a service-based economy. Now, let us clarify some important concepts used in national income accounting, starting with the domestic or economic territory. This is not just the physical landmass of India. It is the geographical territory administered by the government, where people, goods, and capital circulate freely. Importantly, it includes Indian embassies and military bases abroad, as well as ships and aircraft operated by Indian residents globally. Conversely, foreign embassies located inside India are excluded from our economic territory. When we value goods and services, we can look at them from two perspectives: market price and factor cost. Market price is what you, the consumer, pay at the store, which includes indirect taxes like GST. Factor cost, on the other hand, is the actual cost incurred by the manufacturer to produce the good, such as wages, rent, and profit margins. To convert market price to factor cost, we must subtract the net indirect taxes, which means we deduct the indirect taxes paid to the government and add back any subsidies received by the producer. Two other crucial adjustments in national accounting are depreciation and net factor income from abroad. Depreciation, also known as the consumption of fixed capital, accounts for the wear and tear or obsolescence of machinery and assets over time. Net factor income from abroad, or NFIA, is the difference between the income earned by Indian residents working overseas and the income earned by foreign residents working in India. This helps us adjust our domestic figures to reflect the true national income. Next, we have transfer payments. These are one-way, unilateral payments where no goods or services are provided in return. Think of old age pensions, student scholarships, or charitable donations. Because they do not represent current production, transfer payments are strictly excluded from the calculation of national income. However, it is important to note that they are included in an individual's personal income, and they can be subject to taxation.
National income specifically tracks the income of normal residents. But who qualifies? A normal resident is someone who ordinarily resides in India for a year or more, and whose center of economic interest, meaning their production, consumption, or investment, lies in India. This includes foreign citizens living and working in India for over a year, but excludes those here just for medical treatment or studies. It also excludes foreign diplomats or officials working for international organizations like the WHO within India.
Moving on to efficiency metrics, let us look at the capital output ratio. This measures how much capital is required to produce a single unit of output. If you need less capital to produce the same amount of goods, your ratio is lower. Therefore, a low capital output ratio is highly desired because it indicates high efficiency and productivity in the economy. A related concept is the incremental capital output ratio, or ICOR, which measures the extra capital needed to produce just one additional unit of output. In macroeconomics, we categorize goods based on their end use. Raw materials are basic inputs. Intermediary goods have been processed but will be used again to make something else. Finished or final goods are ready for the consumer. Then we have capital goods, which are durable items like machinery and buildings used by businesses to create other products. Finally, consumption goods are the everyday items, both durable and non-durable, bought by ultimate consumers. A common point of confusion for students is the difference between capital goods and intermediate goods. Capital goods are definitely not intermediate goods. Why? Because while intermediate goods are completely transformed or used up in the production process, like flour baked into bread, capital goods are not. A factory oven supports the production of bread, but it does not get transformed into the bread. It remains with the producer to be used over and over again. It is also vital to distinguish between flows and stocks when analyzing economic data. Flows are variables measured over a specific period of time. For instance, your monthly salary or the country's yearly GDP are flows because they happen over a duration. Stocks, conversely, are measured at one specific point in time. The amount of inventory in a warehouse on January 1st or the total value of your assets today are stock variables. Let us formalize the measures of national income. The two most famous are GDP and GNP. Gross domestic product measures all final goods and services produced strictly within the domestic borders of a country, regardless of who produces them. Gross national product, however, measures the output produced by a country's residents, regardless of where in the world they are located. Simply put, GDP is about geographical borders, while GNP is about the nationality of the producers. When we account for the wear and tear of our capital assets, we move from gross measures to net measures. Subtracting depreciation from GDP gives us the net domestic product, or NDP. Subtracting it from GNP gives us the net national product, or NNP. This brings us to a critical definition. Officially, national income is exactly equal to the net national product calculated at factor cost. You might wonder why policymakers in the media usually focus on GDP rather than GNP. GDP is preferred because it measures domestic production. High domestic production means jobs are being created inside the country, tax revenues are being generated for the local government, and export capacity is increasing. While a high GNP is good, the overseas portion of it mostly benefits the home country only in the form of cash remittances, rather than direct industrial growth. Now, let us tackle a critical distinction: real versus nominal GDP. Nominal GDP calculates the value of goods and services using current market prices. The problem is, if prices go up due to inflation, nominal GDP goes up, even if the country didn't actually produce any more goods. Real GDP solves this by adjusting for inflation, valuing output using the constant prices of a chosen base year. Because it isolates actual physical growth from mere price hikes, real GDP is the true indicator of economic progress. To convert nominal GDP to real GDP, we use a discounting factor known as the GDP deflator. Calculated by dividing nominal GDP by real GDP and multiplying by 100, the GDP deflator is actually the most comprehensive indicator of inflation in an economy. It is preferred over the Consumer Price Index and Wholesale Price Index because it covers every single good and service produced domestically. CPI includes imports and uses fixed weights, while WPI completely ignores the service sector, which makes up more than half of India's GDP.
Another fascinating concept is potential GDP. This represents the absolute highest level of economic output a country can sustain over time without triggering runaway inflation. It assumes full employment and optimal use of resources. The difference between what an economy is actually producing, the real GDP, and what it could theoretically produce is called the GDP gap. Potential GDP is driven by technological adoption, regulatory efficiency, and full employment. India faces several structural challenges in reaching its potential GDP. A massive factor is gender inequality. Studies show that achieving gender equality could boost India's potential GDP by a staggering 26%. Other hurdles include chronic underemployment, reliance on outdated production methods, and complex regulatory frameworks that make it hard for businesses to enter or exit the market. However, reforms like the introduction of GST and the future integration of artificial intelligence are actively expanding India's economic potential. To summarize the mathematical relationships we have covered, there are 8 core aggregates of national income. You can easily navigate between them using 3 simple rules. To go from gross to net, subtract depreciation. To go from domestic to national, add net factor income from abroad. And to go from market price to factor cost, subtract indirect taxes and add subsidies. Remember, the 8th aggregate, NNP at factor cost, is the official national income. Beyond national income, we also look at income from the perspective of households, starting with personal income. Personal income is the actual money received by individuals. To calculate it, we take the national income, subtract corporate taxes and undistributed corporate profits that households never see, and add in transfer payments like pensions and scholarships. The key difference is that national income measures income generated by production, while personal income measures income actually received, regardless of production.
While personal income tells us what households receive, personal disposable income tells us what they can actually spend. To find this, we take personal income and subtract direct taxes, like income tax, as well as any miscellaneous fees or fines paid to the government. What is left in your pocket is your personal disposable income. This is a vital metric because it directly reflects the true purchasing power and consumption potential of the citizens.
Scaling up from the household to the entire country, we have national disposable income. This represents the total income available to the entire nation for consumption or saving. It is calculated by taking the national income, adding net indirect taxes, and adding net current transfers from the rest of the world, such as foreign aid. While personal disposable income looks at individual wallets, national disposable income looks at the spending power of the country as a whole. Finally, how and when does the government release all this data? The NSO publishes various estimates throughout the year. It starts with an advance estimate in January, before the financial year even ends. Then comes a provisional estimate in May. Because it takes time to gather accurate data from all states across India, the NSO releases first, second, and third revised estimates over the subsequent 3 years, continuously refining the data until it is fully stabilized. We have now established a strong foundation regarding the terminology, history, and variance of national income. We understand what these aggregates mean and how they relate to one another. In our next segment, we will transition from theory to practice and dive into the actual mathematical methods used by economists to compute these massive economic figures.
Moving right into how we actually calculate these figures, there are 3 primary methods used to estimate national income. We have the product method, the income method, and the expenditure method. While all 3 are theoretically sound, the expenditure method is the most widely used in practice, simply because the data required for it is much easier to track and collect.
Let's break down the first approach, the product method, also known as the value-added or output method. This method captures data right at the stage where income is created. We calculate the gross value added, or GDP at market price, by taking the total value of output from the primary, secondary, and tertiary sectors, and then subtracting intermediate consumption. Why subtract? If we don't remove the cost of raw materials used to make a final good, we end up counting that value twice, once as a raw material and again as part of the final product. When using the product method, we have to be specific about what gets included. Naturally, goods and services sold for profit are counted. But we also include goods supplied for free, like government-provided school lunches, because economic value was still created. We also count own account production of fixed capital and something called imputed rent.
Imputed rent is interesting. If you own the house you live in, you aren't paying rent to a landlord, but the economy still benefits from the housing service, so we estimate a notional rent that you are theoretically paying to yourself and include that in the national income. Conversely, several items are strictly excluded from the product method. Illegal activities like smuggling are left out because they operate outside the formal economy. Non-economic goods like naturally occurring air and water aren't counted. We also exclude the sale of second-hand goods because their value was already counted in the year they were originally produced. Intermediate goods are excluded to avoid the double counting we just discussed. Finally, transfer payments like gifts and capital gains from asset price changes are excluded because they represent a transfer of wealth, not the creation of new output. An important shift happened in 2015 when the Statistical Office decided to report sector-wise gross value added at basic prices rather than factor cost. The basic price is crucial because it measures the actual amount the producer retains, making it the most relevant figure for a producer's decision-making. To calculate GVA at basic prices, we take the GVA at factor cost and add net production taxes. Net production taxes are simply the total production taxes minus any production subsidies received. It is vital to distinguish between production and product taxes and subsidies. Production taxes and subsidies are independent of the volume of production. For instance, a farmer pays land revenue or receives an input subsidy regardless of exactly how many tons of wheat they produce. On the other hand, product taxes and subsidies are tied directly to the per-unit volume of the product. GST and food subsidies are prime examples. To get the final GDP at market price, we take the GDP at basic prices, add the prod taxes, and subtract the product subsidies. Let's summarize the distinction between GVA and GDP, as this is a common point of confusion. GVA looks at the economy from the supplier or input side, measuring the value added by deducting intermediate goods. It is calculated sector by sector, agriculture, manufacturing, services, and is usually expressed at basic prices. GDP, however, looks at the economy from the consumer or output side. It represents the final market value of all goods and services, calculated at market prices, and is essentially the sum of all the different sector GVAs combined. Moving to the second approach, we have the income method, also known as the distribution method. Instead of looking at what is produced, this method looks at the income distributed to the factors of production. Under this method, we calculate the net domestic product at factor cost by adding together three major heads of factor income: compensation to employees, operating surplus, and the mixed income of the self-employed. Let's examine those three components closer. Compensation to employees includes wages, salaries, and, importantly, the employer's contribution to Social Security. Note that the employee's own contribution is already part of their gross salary. Operating surplus captures property and enterprise income, rent, interest, royalties, and profits. Profit here includes corporate taxes, dividends, and retained earnings. Finally, mixed income applies to the self-employed, like farmers or freelance doctors. In these roles, the person is simultaneously the boss, the worker, and the financier, so their income is a mix of wages, rent, and profit. When using the income method, we include commissions earned by brokers on secondhand goods because the broker is providing a fresh service, even if the good itself is old. We also include the value of production kept for self-consumption. However, we strictly exclude windfall gains, like winning the lottery, as no productive service was rendered. We also exclude death duties, transfer receipts, the actual income from selling secondhand goods, and income from selling financial assets like shares and bonds, because these are merely transfers of existing ownership, not new income generation. The third and most commonly used approach is the expenditure method, or total outlay method. The logic here is simple. Every piece of income earned in a country is either spent or saved and invested. By tallying up all the spending, we can measure the total output. This method gives us GDP at market price, calculated as personal consumption expenditure, plus investments, plus government expenditure, plus net exports, which is exports minus imports. What exactly goes into these expenditure buckets? We include all personal consumption spending by everyday households. We include gross private domestic investment, which is when businesses spend money on capital goods like machinery and factories. We also factor in net foreign investment, representing the net spending by foreign nationals and governments on our domestic goods and services. And of course, we include direct government purchases of goods and services for public use. Just like the other methods, the expenditure method has strict exclusions. Government spending on old age pensions, scholarships, or unemployment allowances are excluded here because they are transfer payments. They will eventually be counted when the private individuals spend that money. We exclude spending on semi-finished goods to avoid double counting.
We also exclude purchases of second-hand goods, financial assets like shares and bonds, and imputed expenditures, as these do not represent spending on newly produced tangible goods and services in the current year. Once we have calculated the GDP at market price using the expenditure method, we usually want to find the net national product at factor cost, which is the true measure of national income. To get there, we take our GDP at market price, subtract depreciation to move from gross to net, subtract indirect taxes and add subsidies to move from market price to factor cost, and finally, add net factor income from abroad to move from domestic to national. A modern and increasingly important concept is green GDP. First proposed by the United Nations in 1993, green GDP adjusts traditional economic metrics to account for the environment. It is calculated by taking standard national income and subtracting the costs associated with the depletion of natural resources and environmental degradation. This gives policymakers a much clearer picture of whether economic growth is actually sustainable in the long run. Next, we look at per capita income, which indicates the average income earned per person in a specific area. For a nation, nominal per capita income is calculated by dividing the net national product at factor cost by the total population. To get the real per capita income, we adjust that nominal figure for inflation. To give you an idea of historical growth, India's nominal per capita income was just 7,513 rupees in 1950-51 and is estimated to reach over 2 lakh rupees in 2024-25. When we want to compare per capita income internationally, simply converting currencies at the market exchange rate isn't enough because the cost of living varies wildly. Instead, we use the purchasing power parity, or PPP method. PPP compares currencies using a basket of goods approach, looking at how much it actually costs to buy the same set of everyday items in different countries. However, this is challenging because nations compute their income differently and exchange rate bottlenecks can complicate the analysis. Why do we go through all this trouble to measure national income? First, it quantifies economic growth, allowing us to see if our progress aligns with our national objectives. It reveals the true potential of the economy, helping governments set realistic future goals. Furthermore, detailed national income data highlights disparities, allowing policymakers to take targeted steps to reduce income inequality. It is also an essential tool for the government to accurately forecast future tax revenues. Beyond the government, the corporate sector relies heavily on this data to plan large-scale business activities and investments. National income figures also act as an economic thermometer, helping economists identify inflationary or deflationary gaps, meaning whether the economy is overheating or slowing down. Finally, it provides the benchmark needed to compare the standard of living of citizens across different countries, or even within the same country across different decades. However, measuring national income has distinct limitations. Most importantly, it measures pure economic performance, not social welfare or happiness. A country could have a high GDP but poor quality of life. Additionally, it completely misses non-market transactions. The immense value of services provided by homemakers or traditional barter-based activities still practiced in rural village markets are completely invisible in official national income accounting. Another major limitation is the failure to account for negative externalities. Standard GDP doesn't care if economic growth comes at the cost of severe environmental degradation, industrial waste, or massive carbon emissions. Finally, the sheer complexity of deciding what to include or exclude can lead to erroneous results. Gathering accurate data across a massive, diverse economy is incredibly difficult, inevitably leading to approximation errors in the final figures. Looking at the latest data, the first advance estimates for the fiscal year 2024-25 predict the Indian economy will grow at a solid 6.4%. While this is a moderation from the 8.2% seen in the previous year, specific sectors show robust momentum. The construction sector is slated to grow by 8.6%, and the financial, real estate, and professional services sectors are leading the pack with an estimated 9.3% growth. Meanwhile, agriculture and allied sectors are expected to grow at a steady 3.8%. In absolute terms, the real GDP, which is calculated at constant 2011-12 prices to remove the effects of inflation, is estimated to reach 184.88 lakh crore rupees in 2024-25. This is a significant jump from the provisional estimate of 173.82 lakh crore rupees recorded for the 2023-24 fiscal year, based on the data released in early January 2025. Digging into the detailed report from the Ministry of Statistics and Program Implementation, we can observe the growth at current prices.
Gross value added at basic prices is showing a 9.3% year-over-year change, reaching over 292 lakh crore rupees. Consequently, the gross domestic product at current prices is expanding by 9.7%, crossing the 324 lakh crore mark. Net domestic product closely follows with a 9.8% growth rate.
When we break down the GDP by expenditure components for 2024-25, private final consumption expenditure remains the undisputed backbone of the economy, accounting for 61.8% of total GDP. Gross fixed capital formation, which represents investment, holds a strong 30.1% share. Government consumption makes up 10.3%. On the trade front, exports account for 21.5% of GDP, while imports take up 24.1%. Finally, looking at the per capita figures at current prices, we see broad-based improvements. Per capita GDP is estimated to grow by 8.7% to reach 2,30,195 rupees. More importantly, per capita net national income, the truest measure of average individual income, is also growing at 8.7%, crossing the 2 lakh rupee threshold. Interestingly, per capita private final consumption expenditure is growing even faster at 11.3%, indicating strong consumer spending. With these income metrics established, we will next examine the different shapes economic recovery can take when an economy bounces back from a downturn. Let us examine the various shapes an economic recovery can take when an economy bounces back from a recession or depression. The most optimistic scenario is the Z-shaped recovery. In this model, the economy crashes, but then quickly rises like a phoenix, surging past its previous baseline before eventually normalizing. Next is the V-shaped recovery. Here, the economy suffers a sharp decline but quickly recoups its lost ground. It rapidly climbs back to the normal growth trend line, minimizing long-term economic damage. In a U-shaped recovery, the economy falls and then struggles for a while. It muddles around a low growth rate for some time before gradually rising back to its usual levels. It is a slower, more painful process than a V-shape. The W-shaped recovery is a dangerous scenario, often called a double-dip recession. Growth falls, briefly rises giving false hope, but then falls again before finally recovering. The L-shaped recovery is considered the worst-case scenario. After a steep fall, growth simply stagnates at low levels. The economy does not recover for a very long time, leading to prolonged hardship. Finally, the K-shaped recovery highlights deep inequalities. A portion of the population and certain businesses, like technology and software, recover quickly and fully. Meanwhile, other sectors, like travel and hospitality, continue to suffer. The haves recover, whereas the have-nots bear the brunt of the recession. Moving on to core macroeconomic concepts. Gross domestic product, or GDP, is the aggregate value of all final goods and services produced within a country's domestic territory during a financial year. It can also be understood as the sum total of the gross value added by all firms in the economy. It is crucial to distinguish between nominal and real GDP. Nominal GDP measures the market value of goods and services at current prices, meaning it includes the effects of inflation. Real GDP, on the other hand, is an inflation-adjusted measure, calculated at constant prices, providing a truer picture of economic growth. National income is the aggregate of all factor incomes earned by the normal residents of a country in an accounting year, technically known as net national product at factor cost. Since 2019, these estimates are computed by the National Statistical Office, which was formed by merging the CSO and the NSSO. When calculating national income, we look at the normal resident. This is a person residing in India for 1 year or more who has their economic interests here. A normal resident may or may not be an Indian citizen, and it notably includes Indians working in Indian embassies abroad. There are 3 methods to measure national income. The first is the production method, also called the output or value-added method. Here, we compute the gross value added by taking the total value of output from all 3 sectors and subtracting their intermediate consumption. The second approach is the income method, which calculates net domestic product at factor cost by adding compensation to employees, operating surplus, and the mixed income of the self-employed. The third is the expenditure method, or total outlay method, which sums up consumption, investment, government spending, and net exports. 2 other vital metrics are the capital output ratio and purchasing power parity. The capital output ratio measures how much capital is needed to produce 1 unit of output. A lower ratio is highly desired as it indicates efficiency. Purchasing power parity compares living standards between countries by evaluating currencies against a standard basket of goods.
Let us review how these concepts are tested in the UPSC preliminary examinations. Past questions have required students to correctly match economic activities to their sectors, such as identifying dairy as primary and weaving as secondary. They also test the understanding that mere GNP growth does not mean economic development if poverty increases, and that capital formation can be hindered by a high capital output ratio. Other preliminary questions have focused on macroeconomic trends and definitions. For instance, knowing that a closed economy is one where neither exports nor imports take place, and understanding that national income represents the money value of final goods and services produced by nationals. In the UPSC mains examination, the focus shifts to analytical applications. You may be asked to explain changes in GDP computing methodology post-2015, argue whether India truly experienced a V-shaped recovery, or analyze the determinants of potential GDP and inclusive growth. This brings us to a fundamental distinction: economic growth versus economic development. Growth is a short-term, quantitative increase in production, measured by GDP, and is highly relevant for developed nations. Development is a long-term, qualitative process targeting the optimum distribution of resources, measured by indexes like the Human Development Index, and is crucial for developing countries. Both economic and non-economic factors drive this progress. Economic factors include natural resources, capital formation, and an efficient financial system. However, non-economic factors are equally vital, such as human capital, education, effective law and order, and strong ethical values. Developing economies face numerous obstacles. These include an extensive population burden compared to available resources, high dependence on agriculture, inadequate infrastructure, and severe income inequality. Furthermore, issues like corruption, unsustainable resource use, and a mismatch of skills in the labor force heavily impede progress. Overcoming these challenges requires targeted interventions. We must invest heavily in infrastructure, implement skill-based education through the new education policy, and strengthen the banking network by addressing non-performing assets. Additionally, modernizing agriculture and digitalizing government processes are key to reducing corruption and boosting productivity. Economist Amartya Sen revolutionized this field with his 1999 book, Development as Freedom. He argued that development is fundamentally about eliminating unfreedoms, such as poverty, tyranny, and social deprivation. For Sen, freedom is both the primary end and the principal means of development, relying entirely on the free agency of people. Sen identified 5 distinct types of freedom essential for development: political freedoms, economic facilities, social opportunities, transparency guarantees, and protective security. He emphasized that economic insecurity is deeply tied to a lack of democratic rights, and that functioning democracies are better equipped to handle economic disasters. Conversely, underdevelopment is characterized by a low level of per capita income and a heavy reliance on the primary sector for employment. Common features include low capital formation, high levels of unemployment and underemployment, poor labor productivity, and stark income inequality. To better measure this, the Raghuram Rajan Committee proposed the Composite Development Index in 2013 to determine the development status of Indian states. It uses 10 equally weighted subcomponents, ranging from monthly per capita consumption and education to financial inclusion and connectivity, providing a holistic view of a region's needs. Let us wrap up our key takeaways. We explored how economic recovery shapes shape different post-recession trajectories. We defined foundational metrics like GDP and national income. We also learned that true economic development goes far beyond mere growth by focusing on human freedoms, and that overcoming underdevelopment requires holistic, targeted policy interventions. Keep these concepts in mind as you analyze real-world economies.